David Hunter, it's good to have you back on. I last spoke with you about 8 months ago. Your forecast has continued to play out since then. You're a chief macro strategist with Contrarian Macro Advisors. You're very active on Twitter at Dave H. Contrarian. You're probably the most active person in finance on Twitter that I've seen out there. And I just want to thank you for making the time to come back on and talk with me today.
Yeah, thanks, Logan. Glad to be back.
Yeah, David, I really want to first ask you about a little bit about your forecasting methodology, just because you're probably one of the most accurate people I've seen out there in the last couple of years, at least since I really started paying attention to your forecasts. I just want to first ask you, how is it that you stick with your convictions? Because you're probably the least pliable forecaster I've seen out there. A lot of other people are changing their forecasts a lot more frequently than you do. I just want to ask you, how is it that you really stick with your convictions, that you seem to not move the goalposts as frequently with your forecasts?
Yeah, that comes probably from, I'm definitely a big picture guy, and I'm looking at longer perspective. So as I say, it's counterintuitive to a lot of people, I think, that you stretch out the picture, you stretch out the time frame, and I'm much more accurate. You bring it down to very close at hand, and it's it's harder because it's more related to noise and unpredictable events. But the bigger picture, the trends are more steady, or at least easier to pick up in terms of a long-term trend. And I use technicals, I use fundamentals. I have had 48 years of doing macro, and I use cross market. So I'm looking for confirmations from various markets to tell me if I'm on the right track. And through all of that, it's if I get the same answers from many different directions, my convictions go up. And I'm a contrarian, so if nobody agrees with me, my convictions go up that much more. That may again seem counterintuitive, but it really does seem to be, and I've seen this over my entire career, when everybody agrees on something, you better look for something else, because it rarely is the consensus right. And there are times when the consensus is right, and I am with the consensus, but certainly at inflection points, and we're kind of coming on one of those now, it's much more often than not good to be away from the consensus.
Yeah, good to be away from the consensus. That could definitely be a summary for what being a contrarian is, but it's definitely difficult when you're the only person in a certain bandwagon. At times it can feel that way, I'm sure. Is there a specific formula you have in terms of coming to your forecasts, whether it's the melt up, whether it's the bust later than that, or just specific targets for your S&P or NASDAQ or other targets? Is there a specific formula you have, or is it just kind of almost a intuition at this point that you have after so much experience?
Yeah, it's neither, probably. It's definitely not formula driven. As I say, I have no models. It really is looking for confirmation from several different angles, and having that experience of having been through many cycles. So there's certain patterns that you can see, or certain things that just from living through things. As I say, people go back and look at the 1970s and early 80s because of inflation. And I see a lot of statements made that come from books. And if you live through it as an investor, you have a much more entrenched view of what happened. And lots of times there are nuances there that are not picked up in the book. So that helps. 48 years doing this and living through many different kinds of cycles, and certainly many different Feds. It does give you that history and I've been here before type of thing.
Okay. Now, I know that you've been very successful in the past with managing money, whether it's a pension fund. I think you mentioned you were involved with that at a certain time, and you don't manage money anymore, at least apart from your own. Would you consider managing portfolios again, or are you permanently done with that?
Yeah, because I'm semi-retired. I mean, this is what I do now. It's unlikely I'd go back. I love managing money. Half of my career was that, and I was pretty good at it. And again, I was a contrarian value investor back then, so it fits with what I do now. And I was very much top down, so like this was kind of a natural progression from that. And I feel like a lot of strategists come out of being analysts, stock analysts, bond analysts, etc. There aren't that many strategists that manage money and then come to this. And so that gives me, I think, a bit of a different, background and look to it too, and some edge maybe. But yeah, I haven't really given that much thought because I've been doing this for 20 some odd years. But certainly it would, if the right opportunity came along, maybe. But at this point, I'm pretty happy doing this.
Okay, so you might consider it, but you're also very content with where you are right now.
Yep.
Yeah. I'm curious to hear if there's any past investors who influenced you in the way that you think, or even if it's just, mentors in your life or people like that, how you might have been influenced by other people, or whether it's just a specific methodology you kind of felt fit with you specifically. Would you say you were influenced by anybody, or?
Let's see. I would say, first of all, I was way back in the late 60s, early 70s when I went to college. It was during Vietnam, and so I was kind of, again, one of the contrary people in that I chose finance as a major right out of high school, right into college, whereas a lot of people were going to college to avoid the draft, not have to go to Vietnam. And most of those people were liberal arts or undeclared. So it was unusual to be a business major back then, at least a minority type thing. So I kind of had natural aptitude in that direction and really liked finance. Coming into coming into the workforce, I knew I wanted to get into investments. The opportunity I had was in a small bank out in my college town. It was a two-man operation, my boss, and then I was brought in. It gave me a great kind of leg up in terms of having exposure to everything early on. It wasn't a narrow-based training, and it was a lot of hands-on. So that helped. It was bank investment, which is bonds, and trust investment, which is a lot of stock. And then, I went through banking for about 8 years and then moved to the pension area. I was lucky enough to get into one where I was brought in to be the equity guy. So it was a one-man show for equities within a pension department where we managed bonds, private placements, etc. So that again gave me that ability to kind of do my own thing, and that was where my career took off because I was top percentile performer. Went from there to Fidelity and Hartford, et cetera. But in terms of anybody that really influenced me, certainly along the way, I early on became a value manager that suited me best. I learned early on because I came in '73 the value of protecting your assets, capital preservation, because I came in just at the top of the Nifty 50 market, and then we had at that time, the worst bear market we had post World War II. So that really kind of taught me very early on the value of preservation and managing your risk. And then there were people on Wall Street. Bob Farrell was a technician who could kind of extract from his charts bigger picture stuff. So I'm sure he was an influence. There's a guy named John Neff who was a value manager, very well-known value manager, that managed money for Vanguard, and was a big pension manager. And he was somebody that I really enjoyed his readings and learned a lot. John Templeton, things like that. So there were people along the way that I guess I I certainly looked up to. But you just kind of developed this. I think more my teachings were more the cycle. You learn from your mistakes as you went through each cycle. And I won't say I was a fast learner, but I certainly learned not to repeat the same mistakes each time. So, as you went along, more and more things that you would have maybe done when you were younger, you kind of said, oh, I've been here before, I know this. And then on the contrarian side, I think I was born a contrarian, so that came easy. But in 1977, I read a book by David Dreaman, that was called Psychology of the Stock Market at that time. I think he wrote several reiterations. The last one, I think, was Contrarian Investment Strategies, and that was a 1998 publication. Nothing since. He's deceased now, but he was a long-time contrarian. I won't say the book wasn't really influence on me as much as it spoke my language, and I recommend to anybody as one of the most important things investors can learn is just how much psychology plays a role in investing.
How much psychology?
In the stock market.
Exactly. Yeah. It plays an enormous role. Do you think that's a big factor that a lot of current market voices aren't looking at as much as they should?
Yeah, for sure. I mean, I think that's been true forever. That more people are claiming to be contrarians now, so more people are getting some of it. But yeah, once you're in the heat of it, just like now, the feeding frenzy right now on what the Fed's doing and what's ahead, people can't step back and understand how much they're letting what I call the tape rule their day. It's you see it in pundits, you see it in investors of all kinds. They get wrapped up in the day-to-day movement of the market, which I call the tape, and it influences their thinking. I mean, they just don't really they'll give lip service to it, but in the end, their behavior tells you that they really don't realize how much it is influencing them.
It's certainly easy. I mean, what with the multiple trading platforms, everything where you can just watch the market nonstop these days. One area, David, I didn't know that you were involved with until recently was you're advocate in the area of Lyme disease. So maybe you could just briefly explain like what it is you do in that and why it is that I believe it was a family member of yours who struggled with Lyme disease for a brief period of time. Like what drew you into being involved with this?
Yeah, it was my daughter. She was 14 when she got diagnosed. Probably had been exposed to Lyme a year before, and we didn't realize it. And Lyme can, if caught early, is pretty easy to treat, but if not caught early or not treated properly, not long enough, etc., can turn into a pretty serious illness and can be very neurological in its impact. So in her case, she went from being top student in her class, top athlete in her class, and to where she was basically her brain became so impaired that she'd say, Dad, I can read this to you, but I can't tell you what it means anymore. So pretty frightening to see an A+ student all of a sudden say, I can't comprehend. And that went on. She missed 5 years of school pretty much. She was in school maybe 4 months. She missed her whole freshman year, came back, was in school for a half a year, and then out of school the rest of her high school career. We kept her a 5th year for services. I mean, she was, pretty unique to go from the top student in the district in her class to a special ed student with an IEP. I mean, that's just not something you see often. So it's really why I got out of money management. I went from money management where I had to be in the office to where I had somebody who was covering me say, if you want to be our strategist, you can work from home, because I'd wanted to be with, she was seriously ill. So that started, that was back in 2000. And that's when I started as a strategist. She, after 5th year, did amazingly well on her SATs and got a GED, went to college, got a 4.0 in economics and chemistry. As I say, she almost basically went from 8th grade to college because she missed so much. But just seeing the toll it took on her and the difficulty in finding doctors that understood it, we were lucky within a handful of months. We got it properly diagnosed, and she was with one of the top Lyme doctors in the world. But even that, it took 5 years to get her turned around. And part of, there's lots of reasons, but, because there are other things besides what we call Lyme disease, is Borrelia burgdorferi is the bacteria that causes Lyme. There are the ticks bring in other infections as well that complicate the illness, and she had 3 of them, so that makes it harder. But anyway, because of all of that, I became a big advocate. When she was so sick, I was going out at night. There'd be what we call Lyme literate doctors. I was in Connecticut, and that's kind of the epicenter of Lyme. There were a couple Lyme literate doctors that would come out occasionally and give a talk. You might be in a school auditorium or even a school classroom where there'd be 20 or 30 people there, and you'd have a top doctor in this field kind of going through the illness and the treatment, et cetera. So I learned a lot, and from that, started a sport group in 2004, and have been running sport groups ever since, first in Connecticut, and then I moved up to New Hampshire in 2007, and I've had one up here since then. So it's just such a complex illness with and can be very isolating, where people are so sick that fatigue is a big thing. So lots of people, as I say, and when you have it at a severe level, you can get up. You've been bedridden. You say, "I'm getting up today." You get up and you brush your teeth, and you've used up your energy reservoir for the day, and you have to get back in bed, or you put your clothes on and then are too tired to stay up. And people who don't experience it or don't have it, you look okay sometimes, and so they think you're a malingerer, or you get invited out to dinners and you go, "I can't, I'm sorry." And after many months of inviting somebody and they don't come, or they turn it down, people say, "I guess they're not interested in having a relationship. I'm not their friend anymore." So it becomes very isolating. It's a very misunderstood disease on many levels. So support groups are important in terms of, number one, the emotional needs that people have, and then number two, a lot of discussion about treatments. It's not a one-size-fits-all treatment protocol. It's everybody's a little different, so there's a lot of things you learn along the way. And having done it for 22 years, or studied for 22 years, there's a lot where I can provide information to people that are just encountering it, that don't know where to turn. So it's kind of a second career, if you will.
Yeah, very different than investing, but I'm sure it's been very helpful for your daughter. And yeah, I'm impressed that you were able to pivot that quickly. I kind of got to experience the other side of it with a different kind of, but similarly in terms of how it affects you. I had a traumatic brain injury just about 3 years ago. And so similarly with what you mentioned, during recovery, you're very fatigued. You oftentimes feel alone, things like that. So I almost got to experience the side that your daughter would have experienced. And yeah, my mother came alongside me when I needed help with that. So kind of very similarly to what you did. I also got to experience.
It's in fact, Lyme sometimes in that very chronic neurological form does look a lot like a traumatic brain injury, because it's inflammation of the brain is a big part of it. The problem is medical establishment treats it as you've been treated for 3 weeks, you can't have Lyme anymore. You know, what you have is some lingering effects that'll go away. And that's not true. And I won't go into detail, but it's a bacteria that can be very stealthy and can do a lot of things to, despite treatment, survive. And it creates inflammation in the body and in the brain that can be very debilitating. So it does. It looks a lot like TBI, and I also will tell you, yes, if you have a parent or parents that are very supportive, you're lucky, because even parents can kind of get lost in this and have a statute of limitations where they go, you just got to get back on the horse, you know, son or daughter. You're not, you know, it looks even to parents or to spouses sometimes like you're not trying hard enough, and people can't understand what they can't see. You know, it's an invisible disease in some ways.
Absolutely. Yeah, I'm sure we could talk a lot more about this, but I definitely want to get more into your melt up calls and then your economic bust calls. So I guess we'll maybe progress onto that now. To put it shortly, you see the Fed needing to pivot pretty quickly with the deceleration of the economy, even though inflation is now, you know, much higher than they would like it to be. You essentially say that, you know, the Fed is going to need to prioritize getting the economy going again, perhaps, you know, definitely not raising rates as much as might be being priced in right now. Would you say that it's likely that they actually continue to expand their balance sheet, actually do more quantitative easing, or?
Yeah, it's interesting because obviously we've had 1/4 point hike, and yet I'm out here saying I think the tightening cycle is almost over. As I've said many times, the bond market did the tightening for the Fed. The bond market anticipated, based on what the Fed was saying back in the fourth quarter of 2021 and before, that the Fed was, you know, beginning to was getting ready to tighten. The bond market saw the inflation and certainly saw it ahead of time and started discounting that. So what we've had, it's an unusual period because it's not the level of rates so much as the speed with which rates have gone up, right? So when you come from zero and you go up, or when you come from close to zero and go up, and you know all of a sudden you're at 2% on a 5-year, it's a big change, right? It's a huge change. It's not the nominal level of interest rates, it's really the rate of change. And so other than Fed funds, you know, along the curve, we've seen a big jump in rates percentage wise. And so it's, you know, and yet real rates are obviously are negative and very negative because inflation's, whether you pick 5 or 6%, or you pick the, you know, kind of the monthly numbers that look like it's 8 or 9 or 10%. Any way you slice it, you know, nominal rates are far below inflation. And so you've got negative real rates, and people go, oh, that's not tightening, you know, we're very loose. But it's that rate of change. And for example, housing's obviously the easiest one because it's so interest rate sensitive. You've gone from, you know, a 2.5% mortgage rate to a 5% mortgage rate. That's a huge change. And it's a huge change on the monthly payment. And so you're going to see, as you're seeing in the home building stocks, you're going to see, you know, a change in housing. And again, it happens with a lag. It doesn't happen, you don't see it in the immediate aftermath of a rate increase. It takes a little time. And same thing with, you know, other interest sensitive purchases, whether it be appliances that are related to homes or furniture, or, you know, autos, or other interest rate sensitive type activity. It's gonna show up in the coming months in the data. Now, you would think the Fed knows that, and they do, but and that's why Powell dragged his feet. He said, well, we're going to see, you know, this inflation is transitory, and we're going to, we don't want to overreact to short-term inflation because, it's transitory because of supply chain issues and Ukraine, et cetera. And then all of a sudden, this last couple of months hit, and they can't ignore the fact that inflation is really accelerating, and certainly gasoline. That's another thing. Gasoline prices have doubled or more, and that's taking money out of the consumer's pocketbook. And you're seeing it in retail sales. You're going to see a lot more of it in the coming months. Consumer confidence is at levels that has indicated recession before. It's down at the bottom levels. So those kind of things are all leading indicators of an economy that's going to slow down, is slowing down dramatically. And again, the Fed knows that this happens, but they don't know to the degree and the speed with which it happens. And and we're in that unusual time where we've only hiked a quarter point. How is that going to have any impact on the economy, right? So he's certainly getting pressured, even by the administration. Ironically, the administration looking at polling numbers and saying, we're getting beat up because inflation's soaring. Consumers are really angry, and we're getting blamed for it. Come on, Fed, you've got to help us. So normally the president's saying, we got an election coming up in November, keep the skids greased, keep pumping money because we want the economy good. The problem this time is inflation's at the top of the list of consumer worries. So they've, Powell's getting it from all sides. He's getting it from Wall Street saying, you're way behind the curve. He's getting it from, Al Summers and the administration and Democrats saying, you're killing us. You've got to do more to fight inflation. And so naturally he bends to that pressure. And certainly some of his Fed members were probably further along than he was. But he's come along where it's now, after being behind, now he's leading the charge and saying, okay, we got to do a half point, maybe another half point. Who knows after that? That's shaking up the markets and certainly shaking up the bond market. And you're pushing rates up pretty quickly. Again, we're low on a nominal basis, but we've had a big change in the last few months. And I think, ironically, we're seeing the same thing we've seen with the Fed every single cycle, which is that they're going too far. They're reacting at a time when they should be looking out over the horizon and saying, okay, we can't go further. They're reacting by going further. So people want to know, do I think he's going to stop hiking after the next one or before the next one? I have no idea. I can't predict what a human being's going to do. I can try, but that's not where I spend my time forecasting, is what's the Fed going to do next meeting or the one after. And that seems to be what economists like to do, and what strategists like to do is spend their time telling you what they think the Fed's next rate hike's going to look like. I look more at the bond market and what's going on. And so all I can tell you is that coming up, and he could be two and done. I don't think he's one and done, because I think the May meeting's probably too close at hand. But I think there's a real chance that even though he thinks he's going to be hiking for, make 7 hikes this year, and he thinks he's going to have at least 2 or 3 half-point hikes, it very well be by the time we get to June, they're looking at an economy that's really in the tank, and he's saying, we got to pause. At the very least, we got to pause, and maybe we have to go the other way. But certainly, I think my view anyway is that the bond market is very close to, meaning 10-year treasuries and 30-year treasuries are very close to the top of their rate cycle. So we're at 260 on the 10-year or thereabouts. Maybe we can go 270. We're at I think we're close to 260 on the 30-year. That can probably get up to 275, 280, but I think that's the top of the rate cycle for this time around. And I'm calling for obviously a global bust to start maybe late this year, and maybe and carry through most of next year. I think at the bottom of the rate cycle next year, the 10-year will be 0 or negative. So you could have a negative rate 10-year. The 30-year will probably be 0.25%, maybe a half. So in other words, I think bonds are at the bottom and ready to rally, and yet the street has all kinds of forecasts of higher rates and dire news for bond investors. So again, my contrarian view is kind of people scratch their head and go, "What are you looking at?" But that's where I'm at.
Yeah. So you'd almost say that would be the kind of fundamental driver behind equity prices melting up and everything else melting up as much as your targets are from here, is just the pivoting of the Fed from supposed tightening, or what is being anticipated will be tightening, to not as much tightening, and if anything maybe even more easing. So
yeah, let's put it this way. I think the market will turn before the Fed. So it's not like I don't know what's going to happen at the May meeting. I doubt that they pause. It's possible that the economy will be showing enough information of the deceleration that they will pause. But I think more likely you assume that there's a half point in May. I think the market turns in April. So I think the market will have turned before the rate cycle, well, the Fed rate cycle. But the bond market may have already turned before the Fed's 50 basis point hike won't necessarily be coinciding with a bond market that's still sending rates higher. I think rates could have already turned down by then. And again, as I've said for many months, the bond market leads and the Fed follows. The Fed doesn't set rates, the bond market sets rates and the Fed follows. So I think, again, we'll be in an easing cycle of some sort, and ease is relative. It could be we've just paused on tightening, or it could be that they actually ease for a little while. Now, the hardest part to convey on Twitter is that this stuff is not linear. So people hear it's either tightening cycle or easing cycle, or it's either stock market's in a bull market or it's in a bear market. These things aren't all linear. They don't all fit together like a glove, where every market does the same thing exactly on the same sequence, relating to the same facts. It may very well be that the Fed still thinks they're in their tightening mode. They're just taking a month off, but the market's taking it as, yeah, we know the Fed's got to ease. We're going full bore. Or it may well be that you get a couple things. You get some kind of negotiated settlement in Ukraine, and at the same time you've got questions about what the Fed's going to do. That tightening's not, the estimates built into the street model are not 7 hikes anymore. Now it's 4 hikes. That's easing in the mind of the market, right? So it's not all as straightforward as the Fed easing or as the Fed tightening. And then I think you're going to have an explosive situation because everybody's so bearish. I'm not sure where sentiment is right now, but back in February, the sentiment was pretty much on the same par with March of 2020.
It's remarkable.
Which was just as bearish as you could be. When I step back and look at the picture in the stock market, this looks like an inflection point similar to not quite March of 2020, but maybe January 2016. And you had big legs following both of those. And that's what sentiment's really saying, is we're setting up for, what I call rip-roaring run here. And I think it's going to be the steepest one yet, so we'll cover more ground in a shorter period of time. And that's why I can say I think within 3 to 6 months you might top out in the market. This is the end again. You're probably going to see when that starts happening, people claiming that it's got 2 years to run or whatever. This is the end of a secular bull market. So I'm not calling for this to go forever. I'm just saying that you've got maybe the biggest rally in history coming, and it may cover ground from say 4,300 on the S&P to 6,000 on the S&P may happen in 3, 4, 5 months, and then it could be like the roadrunner running off the cliff. All of a sudden you look around, you go, whoops, there's nothing underneath us. Wow, the economy's still decelerating. Wow, we've got a bust on our hands, and down we go. So it's I think the weakness in the economy that we're going to get now is probably the start of what will lead to a global bust. It's not that we'll be in that bust type environment for the next 6 months, but we'll be beginning the process of moving towards that.
Interesting. So even though you see perhaps the economic deceleration not correcting very much, even with the Fed, or even with the mentality of, psychology of the market shifting, you could see that as kind of the beginning of this economic bust that you see coming later after the melt up. Interesting. I just want to briefly touch on your equity targets, the targets that you have during the melt up, prior to the bust. You've adjusted those since I last spoke with you. I think your targets for indices are now S&P 6,000, NASDAQ 20,000, and Dow 45,000. Are they still there, or?
Yes, yeah, that's right. In my January letter, at the beginning of January, I raised my S&P target from 5,300 to 6,000. And people may think that's ironic because that was on the verge of the correction. But I was calling in that letter for the correction. I said, after the correction, this is where we're going. I just saw, again, stretching out the picture, it wasn't about what the next few months look like. It really is, I just saw there's more potential here. And so 6,000 on the S&P is right. 45,000 on the Dow and 28,000. I think I was 42 on the Dow prior to that. I was 18,000 on the NASDAQ and raised it to 20,000. And I also have a 3,000 forecast for the Russell 2000 index. So they're probably highs on the street, and most people think I'm crazy because people are talking about the market going to 3,500, the S&P to 3,500, 3,000 in the next few months, maybe lower. So people think we've seen the highs. I'd say the majority, vast majority think we've already seen the highs. I keep having people tell me, the melt up's already happened. Your melt up, you're late. You're wrong. You called the melt up and it's already happened. And I do explain that I kind of shortcut things sometimes in my tweets because you don't have much room. And I say melt up. What I really mean is a final melt up leg. I go, yes, we've really had a melt up from the March 2020 low. The index has more than doubled in 21 months. So that's a melt up. But the final leg is going to be even steeper than that. So I call it the melt up, but it's really a final melt up leg if I stretched out the definition or the term. So most people just don't think you have that next leg coming.
Yeah. And so if anything, that would indicate that there's, probably a significant amount of money just sitting out there on the sidelines that would, in a way, cause this final leg of the melt up.
Yeah, it's interesting. Like I get that question a lot of, well, where's the money going to come from? The liquidity is gone from the market. And I go, in 2008, we had 875 billion total as a balance sheet for the Fed. Today we have 9 trillion, and most of that 9 trillion, 5 trillion of that 9 trillion has occurred in the last 2 years. I mean, the Fed pushed money out the door like never before. there's liquidity out there. And if you look at it, if you bring it closer to the reality of where's the money, hedge funds are short and defensive. Retail investors are defensive. Pension funds are defensive where they can be. Everybody's allocated cash. Now, maybe they have 10% cash. Some more aggressive funds may have 20 or what have you. But there's plenty of people who have gone defensive. This market won't have a problem fueling the run. I mean, I always think that's a funny way to look at the market. I look at it from a sense, if there's a wall of worry, there's fuel for the market.
Yeah.
Because that means people have already acted on their bearishness. So it's kind of silly, but there's an awful lot of pundits out there that will tell you there's no liquidity for the kind of rally I'm talking about. There's plenty of liquidity. People are really bearish.
Yeah. Yeah, shifting onto an area that has begun to shift. It hadn't when I was last talking with you. Gold and silver have rallied significantly with the Russia and Ukraine situation right now, but that's another area that you see strongly performing during the melt-up. Do you have any higher targets with gold and silver or the miners? Or?
Yes, I haven't put out my second quarter letter yet. It's coming out in the next several days. But I will be raising my gold target. I won't say what because my readers will get it first, but I am raising that. I'm leaving my silver target the same. My minor targets are pretty much the same, but I mean those are aggressive targets. I have a target of 2,500 right now on gold, and $50 on silver, and the ETFs for the miners are all 75, 100% higher than they are now. So there's big runs coming. And I may be conservative even with my raised targets, but I'm pretty comfortable that I'm on the right track. I think we're on the verge of a very big move. It probably does move in the melt up. I thought it might have moved. I had called this correction in the markets. Said the S&P could get, when it rallied from mid-March, I said we're probably heading for 4,600. And then from there, I think we can have a 6 to 8% pullback, which would take you back to say 4,300 on the S&P. I think that's where we're headed short term. And I thought maybe in that pullback, you might actually see gold and silver go the other way. They've kind of pulled back with the market. They've held up better than the market, but they haven't gone up a lot. I think the rally in the gold, silver, and miners is probably going to coincide with the melt-up. Pretty much, and they look spectacular in my work in terms of both intermediate term and longer term moves. So I think that's probably the most underappreciated asset right now, or a segment of the market. Everything else has gone at one point or another in the last couple of years. And gold and silver have been in long consolidations and really haven't emerged from them yet. They've started to. They're looking better, but they are, once they break out, I think you're going to see some very big moves.
Yeah. And one area that you don't mention much, you say that you don't follow crypto. I'm curious to get your thoughts, though, from like a psychological perspective. Do you think a lot of crypto's performance has just been because of the price action drawing in, just retail investors out there? Or because
my sense, and I have to certainly say it's from a very far distance because I really don't watch crypto at all, and so I can be, maybe my perceptions can be misperceptions, but from where I stand and using my 48 years of investment background and experience, it just strikes me that there's a lot of interest in crypto that has to do with the momentum of it, just like any momentum stock. In other words, once something gets going, the story starts feeding on itself. You start hearing how great it is, and then that same story. I'm talking about a stock because that's prior to crypto. And then once it turns south and it becomes broken, immediately the sentiment changes, the story changes, right? And so crypto is no different than any other asset in terms of there's a psychological component. And at least from a distance, I feel like that psychological component is a lot bigger than the crypto investors understand. And I see some of the same characters who proclaim themselves, great prognosticators of stock markets and then fell on their face as hedge fund managers, et cetera, in crypto now, making their name in crypto, saying, kind of the same way. And it bothers me a little bit to see the speculative nature of it. I don't know what the long-term picture is for crypto. As I keep saying, I think it needs to at least get through the bust and be tested to have any idea of what it really is. And the other aspect of it that bothers me is even before crypto, the Austrian school hates central banks, hates banking system that does this artificial propping up with the fractional banking system, et cetera. Wants desperately to see that go away, either have a gold-backed currency or something outside central bank control. Crypto has been their godsend. They think, okay, here's what's going to do it. We can get outside the banking system. It's unregulated by the banks, and it can be more supply and demand driven, right? I have my issues with central banking, and I have my issues with how our economies have been driven up by all this money printing. So I'm sympathetic to some of the view, but I think the Austrian view is where they would love to just shoot the Fed and say, as I say, if we did away with the Fed tomorrow, or if we put the dollar on the gold standard tomorrow, we'd all be living in caves, because if you don't inflate the money supply now, you're in trouble, because the debt levels and leverage are so high. But anyway, I think crypto is also kind of caught their fascination and their attention. And so I worry about what is really driving crypto. Some of it is legitimate, but some of it is really these other things. And so let's see how it does in the bust, and then go from there. And it's not that I believe, crypto's going away, but certainly several of the cryptos will go away. Bitcoin probably is the survivor, the one that has the most legitimacy. But even there, let's see what it does in the bust.
Yeah, I agree that it really is a very untested market, and it correlates very heavily with, risk on, risk off type of, other high flying equities out there. I'm curious to get your perspective on whether or not gold is manipulated by central banks, because I know you're definitely, in past times that I've talked with you about this, you've said that, you don't think the Fed is manipulating gold, but I almost think that in talking with some people I know who are into crypto, that has been a factor that has driven them to crypto, is they think that, gold, even though it could perform well, just isn't being allowed to by the Fed. But crypto might offer this other opportunity that they aren't controlling yet. But I'm curious to get your thoughts on, whether the Fed really cares about the gold price, or, yeah.
Yeah, I could be wrong, but I don't think the Fed pays a lot of attention to gold. Gold's viewed, I think, as an antiquity. It's outlived its usefulness. It's not, certainly the dollar doesn't depend on gold. Now, maybe what's going on with the ruble will reawaken interest in gold, and central banks will pay more attention to it. I think China cares about gold. I think Russia cares about gold. But the manipulation, I'm not in the manipulation camp. What I say is trading desks certainly play games with everything. if they want to accumulate a position in something, they sometimes will go the other way to kind of give you better opportunities. And so there's there's manipulation in all markets, but it's legal manipulation typically, where they can kind of feign a move in one direction, and it provides an opportunity because then investors chase that to that level, and then they come in and actually build the position the other way. So but in terms of central bank manipulation, I really don't think that's the story. I know there's a story out there, the JP Morgans of the world that are short the metals in some big way, are suppressing the price because it would really hurt them if it broke out. The commercials are certainly hedging and are typically short, because they're locking in prices, et cetera. That's been going on forever, and that's not manipulation. It's really their way of managing their operations. So, and that may haunt them. We've had situations in the past. I remember Barrick Gold at one time was a big hedger and had to abandon it because once gold broke out back in the 2001 to 2011 period there, it became very much a harmful exercise to the operation. So I think all those things are legal and can go on. And then you had the spoofing, and some people go, "See, we told you it was manipulated. We told you the banks were manipulated." I go, but that's dealing with pennies. I mean, what they did was illegal, but it was really, it's not a suppression move. It's not something that keeps price down. It's skimming, and so people, again, because they have manipulation in their mind, kind of jump to conclusions that are faulty conclusions. So I'm just not in the manipulation camp. As I say, gold went from $250 to $1,900 in 2001 to 2011. In that decade, we didn't hear much talk of manipulation then. It's only because gold's been in this long consolidation since 2011 and it hasn't gotten back to its highs. And people were expecting much more out of it over the last several years. That again, that people have to look for some blame there somewhere. It doesn't make sense to them that gold is down, but that's how markets are. Sometimes markets are out of favor for a very long time, and when they come back into favor, then you have a big run. And as I say, markets determine the time, not you or I. It's not, we may want something to happen in the next 6 months. If the market's not ready, it's not ready.
Yeah, and I think with all of your calls in the last 2 years, it's taken significantly longer than you initially thought. I think, yeah, especially with gold and silver, it's just the consolidation after the run that they had out of the March 2020 swoon. It's
it was when we came out of March and we had the big move, gold went 50% from 1,400 to, I think, if I'm right, somewhere near 1,460 to 2,100 in 4 months, and silver went from 11 to 30, I guess. It was, it looked like what you'd probably have is you needed a rest. I thought we were going to have a consolidation, that maybe we'd have a 3-month consolidation and go again. And 3 months turned into, 18 months. And so, yeah, for sure, I was, premature in expecting the next leg to get started. But again, other people that would, it bothers the traders because they're trying to trade based on time. For somebody like me, it's like, well, the market took longer to consolidate, but there's still another leg coming. It doesn't mean the leg isn't coming. It's just that, the next up leg isn't coming. It's just a longer consolidation for any number of factors. And that's hard for traders to understand because they think time is everything. And I go, time's not, in my big cycles, time's not the issue.
Absolutely. Would you say that that's maybe the area that you could see being drawn out is just the timing of this last melt up leg, whether it's in the stock market or your gold and silver targets? Do you think that could maybe just be the area that, at the soonest you might see it happening during this summer, but it could get drawn out as it has, in the last 2 years?
Certainly can happen. I will say, as I said, I expect the next leg to be parabolic in the equity market. So that's why I'm still sticking to the next 3 to 6 months. If it's a lesser slope, and truly we do get the Fed easing, and this is a longer type process before they have to go the other way again, then sure, instead of 3 to 6 months, it could go 6 to 9 months or what have you. I still think that the rally to was 21 months from the bottom in March to the top at the end of 2021 in the equity market. So it's not going to be longer than that. It's probably going to be half of that at the longest. So that that takes you to say maybe 9 or 10 months. But I don't even think that's likely, because I think it's a steeper sloping rally, and because I think the start of the slowdown is already happening, and that it's not. We could have a pause. You could have the economy negative in the second quarter, positive in the third quarter, and then go down. You can have it doesn't have to be a straight line, but if it is a straight line where each quarter is negative, moving towards a bust, you don't have a lot of time. But again, people misunderstand that. It's the market will determine, and the economy will determine how much time we have. There's not a clock on this. It says, okay, it didn't happen when you said, so therefore, you said it's got to happen by August. I go, it doesn't have to happen by any time. It all is determined by, what else is going on. So my best guess is it's the next 3 to 6 months, and I think it's probably, this summer. But yeah, I'm the first one to tell you, don't count on the time based on me, because I am typically early.
Yeah, don't buy call options based on you, or do any sort of trading.
I think that's a lot of the so-called Twitter trolls are option traders.
Yeah.
I go, mine are forecasts. These are not trading calls. Don't go, when I put the time out there, I'm saying at the earliest it might do this. That's not when it's going to happen. That's at the earliest, and at best it's a best guess. It's not it's not a precise forecast.
Absolutely. Well, I understand that taken up all the time that you really wanted to, but I really do appreciate your time, David Hunter, and I'll just leave the last few minutes for you to finish up with any final thoughts you have. I understand that you have a subscription layer that people watching this can subscribe to. They can direct message you on Twitter for more information, but I just want to thank you for your time and give you last few minutes for you to finish up.
Yeah, I guess probably the thing I would say to people is just this next probably 3 to 6 months could be historical in terms of, I keep using the word stunning. If I'm right and we finish this correction up sometime in the next week or two, what comes from there could be very fast and very furious and historical and stunning in terms of pretty much record breaking in terms of how much ground we cover. Because I'm calling, using my targets, you're talking about basically, in some cases a 30, 35, 40% move, and in other cases a 50% move in 6 months' time, let's say. As we talked earlier, tape really, or momentum of the market can really drive psychology, and I can predict with a lot of conviction that at the top people are going to be the most bearish and the most bullish they've ever been, or the most bullish they've been in this cycle. And you've got to fight that psychology and understand this is not the beginning of something great. This is the end of something. In other words, this is the final hurrah in a bull market. It's not the beginning of a much longer bull market. So I just caution people that don't get too caught up in the tape when it goes. I'm not giving investment advice on how you play it, but just understand that for most people, you're going to be most bullish at the top and most bearish at the bottom. And right now, people are pretty bearish, and they can rationalize it with Fed action, et cetera. But the psychology is that you're bearish right now, and at the top, the odds are pretty good that the vast majority of people are going to be thinking this is the beginning of something great. So try to fight that. So with that being said, yeah, you can find me at Dave H. Contrarian on Twitter. And I do have a quarterly letter that I put out that if people have interest in it, it's by subscription, which means there is a cost to it. But if they have interest, they can just direct message me on Twitter and I'll provide details. And we should be in for quite a ride here in 2022, I think. Maybe a roller coaster ride, but a ride.
Yeah, it sounds like it, David. I would like to have you back on at some point when, in fact, everyone is bullish and you're the only bear out there. So thank you for your time.
Okay, Logan, you take care.